We're really excited and optimistic about Japanese equity markets, and I think it's a story of transformation along a couple of different axes. Japan has just exited a prolonged multi-decade period of deflation and very slow growth. And so real wage growth finally has come back to Japan, and that has some really positive implications for demand, for consumption, for growth, for the ability to invest capital. So that's one major change. The second, Japan has, after 15 years, begun to normalize its interest rate policy. So we've now had a return to interest rates. That allows banks to lend and feed the economy and generate a return. The second category of drivers is really along improving and really dramatically improving corporate governance and corporate balance sheets. The Tokyo Stock Exchange, as well as the central government, have made a push over the last couple of years to meaningfully enhance the way that businesses communicate with shareholders and the way that they manage their balance sheets and deploy capital, and with the goal of really invigorating and making Japan a much more dynamic and globally competitive market.
There's one company we own, Toyo Susan, which is the largest ramen manufacturer in Japan. They're second in the United States. They're number one in Mexico. The company has about 30% of its market cap in cash on the balance sheet. They have an activist investor who's gotten involved, and they will be publishing a new medium-term plan in May, at which time we expect them to make a significant increase in the dividend, maybe doubling the dividend, as well as announcing a share repurchase program. That would make a much more effective use of capital. It would raise the return on equity, and the stock trades at its lowest valuation in almost a decade. So we think that the combination of all that has the potential to unlock value for shareholders. I'll start with one area, which is in healthcare. Contract development and manufacturing organizations, or CDMOs, are very important companies in drug manufacturing and developing drugs and getting them to the market faster. These companies are located outside the United States. There are no big companies within the United States. The leaders, one is in Korea and one is in Switzerland. And they have a big opportunity because the drug companies throughout the world have recognized that manufacturing is a critical aspect to what they do. They've been world-class at R&D, but they've not necessarily been world-class at manufacturing. And we're moving into much more complex molecules, biologics, cell and gene therapy, anti-drug coagulants, all of those that require a more challenging manufacturing process. And that requires a more sophisticated company to be involved. And that is an area where we think there could be many years of higher pace of growth because of the sophistication required that these companies can provide. I'd be remiss if we didn't mention maybe the largest market cap company outside the United States as far as innovation. So there are $9 trillion market cap companies in the world, 7 located on the west coast of California. Then there's Saudi Aramco, and the last one is Taiwan Semiconductor. And Taiwan Semiconductor is an incredibly innovative company. They are the only foundry that makes semiconductors, and their importance in the world is only growing. And we think this is a company that can grow for many years at high rates.
We just thought of another area with growth outside the US that's kind of a surprise to US investors, and that is banks, which tend to be in emerging markets, but actual growth financials. These are well-capitalized companies, extremely well-run businesses that are often attacking growing markets and that are populated by largely public sector banks that are not run, for profitability and efficiently. So better efficiency ratios, strong growth, very good returns, and companies that are well-run with a long runway of growth in front of them.
On market inefficiency, there's a lot of definitions of it. What we really try to do is identify the factors that lead to market inefficiency. We believe there are 5 key factors that put together help define the amount of inefficiency in a market. So first is the number of companies in a market. That is, more companies, the more inefficient the market is. Then we looked at the number of institutional investors that own shares. It is more challenging to trade against an investor that's at a sophisticated firm than someone who's an individual with less knowledge. And third would be the number of sell-side analysts that cover a company on average. More analysts, the more information that's out there. Now, those three are not part of an alpha thesis or anything, they're just sort of facts. The other two directly connect to how we invest and how we talk about companies, which is the magnitude and frequency of forecast error in the sell side or consensus estimates. We are looking in our investment process for forecasts that are materially different than the consensus. So it turns out to help define market inefficiency is measuring how wrong the consensus estimates are and the frequency of that error. And we put those 5 factors together in a simple equally weighted forecast. It matches or correlates very well with excess return potential. So everything we do and how we've designed our firm and how we've designed our investment process is to take advantage of that forecast error, and the amount of it in emerging markets and international markets is far greater than in the US markets.